Futures higher to kick off a busy week in earnings and central bank meetings. 30 minutes until the start of the cash trade. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, a trio of central bank meetings this week. We'll get decisions from the BOJ, the Fed, and the Bank of England.
We also get earnings from a quartet of Mag 7 stocks worth nearly $10 trillion combined. Microsoft, Meta, Apple, and Amazon results all on deck this week.
But first, we'll dig into McDonald's as the change sales fall for the first time since 2020. Let's take a check on these markets. About 30 minutes until the bell rings. You can see we have a lift to futures right now ahead of that very heavy week. The S&P 500 up about 0.4%. You have big tech leading the way. NASDAQ 100 up about 0.7% with some big earnings on tap, and the bond market, that rally just continuing. The 10-year yield currently down about 4 basis points. We're camped out at about 4.15%, Matt.
All right, take a look at real rates right now. Even though you think they may not have come down everywhere, certainly not at the Fed, as we get inflation cooling, real rates begin to rise for the central bank here, for the Bank of England, for the Bank of Japan. Here you see where we are, and that could indicate more willingness to cut over the next set of meetings. That is going to underpin the market, but let's look at the stocks underpinning the market right now. McDonald sales fell for the first time since 2020, yet the stock is on a rise pre-market about 0.7% higher. McDonald did keep its forward guide stable. Tesla also on the rise as Morgan Stanley names the top pick in U.S. autos here, up now 1.6%, Matt. All right, that's an interesting call by Adam Jonas. Love to talk to him about that one. But we've got a lot going on outside of autos, right? Last week we were very focused on Ford, Stellantis, and General Motors. This week we've got all of the mega cap, or 4 at least, of the mega cap tech companies reporting.
Yeah, absolutely.
As well as some mega cap central banks.
We have some mega cap central banks, and I know there's a lot of focus on tech, and there should be, but we also have big oil reporting this week. Of course, we have McDonald's, Starbucks, Wendy's, so a really nice snapshot of really Wendy's. The entire economy. All capped up by payrolls on Friday, so busy until the very end. Yeah, let's talk about that right now. We want to bring in Kate Moore because it's, as we said, a big week for markets, a big week for earnings, a big week for central bank decisions. Actually, first we're going to go to Michael McKee here. He's standing by, Bloomberg's chief international economics and policy correspondent. Mike, I forget about you because you're over there in the horseshoe.
I'm the warm-up act here. You know, I got to get the audience warmed up for Kate. We'll do that because we do have a lot going on this week, and we start with the central banks, as you were talking about. We have the Bank of Japan and the Federal Reserve reporting on Wednesday. The Bank of Japan early in the morning, our time, and then the Bank of England on Thursday, and we're not expecting real moves from the Bank of Japan or the Bank of or the Federal Reserve, but we might get something from the Bank of England. Now, if you look at what the OIS forecasts are for the 3 banks, you can see that it is a question mark about September. That's not our chart, but it's a question mark about September, but
that's mine, Mike.
That's yours, yeah. A question mark about July, but in September, all 3 banks are expected to be moving, and the difference, of course, that's the chart. Is the blue line is the Bank of Japan. They're going to be going the opposite direction. They've got inflation, and now they're thinking it might be a problem after all these many years. So keep an eye on the Bank of Japan going the opposite direction. And if that happens, of course, you're going to keep an eye on the yen, which has strengthened in recent weeks on predictions that we will see that divergence. The Fed start cutting way over on the left-hand side. You can't even see what the odds are of the Fed moving on Wednesday, but it's going to be very, very low. And then, of course, you were mentioning jobs on Friday, but we got a lot of data before that. We've got the JOLTS report coming tomorrow. That always moves markets. Consumer confidence. ADP gets traded on, whether it makes sense or not. And ECI, the Fed wants to know what's happening with wage pressures. Thursday, ISM manufacturing, jobless claims, are those coming back down again? And I don't even have to promote Friday. I know you guys will be beating the drum for that all week. Jobs Day. Everybody has to stay in town this week for all this data.
Yeah, some top-tier data coming out at the very end of the week. So we have the Fed. We're keeping an eye on the BOJ as well. And the Bank of England, we should mention, that really feels like a live meeting, Mike McKee.
It is a live meeting, and it's just about 99% that they do cut rates. But the bank has been pretty divided over this for a while. So it is possible they hold off. We're just going to have to wait and see where they see the balance of risks at this point.
All right, Mike, thanks very much. Michael McKee there in the horseshoe giving us the lowdown. Right now, let's get to Kate Moore. She is head of thematic strategy for Blackrock's global allocation investment team. And I guess we could start on central banks since we just heard from Mike. We had a blowout GDP number last week. And nonetheless, most people are still calling for rate cuts. Do you expect September to be it?
Yeah, we're in the September camp for sure. And we think there's a great likelihood, actually, that we could get 3 cuts in 2024, and then 1 in the first part of 2025, and then kind of a pause that refreshes. We'll take a look at kind of the impact of the 100 basis points of cuts and see what that does for the economy. I think your point, though, around the GDP number is important, because we've had a lot of cross currents in the economic data. There has been, some indication that the economy and the consumer are in good shape. And then you get anecdotes from companies and sometimes from the labor market that suggest there's some cooling. So I think being a Federal Reserve decision maker right now is an incredibly difficult job. And they want to be cautious, especially going into the election.
Kate, why 3? That brings you above consensus. What would cause the Federal Reserve to have to cut rates 3 times? Is that a sign of weakness or strength?
Well, it depends on how you cut it. I would say we're not as stressed out about the labor market softening too much, and that being the reason for the Fed to continue to ease in 2024. It's more about our expectation that we're going to have more disinflationary pressure over the course of the end of the third quarter into the fourth quarter. So I'd say that's a positive sign. And against that backdrop, we think consumption is going to be pretty good. So even if we're calling for kind of 2 to 3 this year, we're in the camp of a pretty good economy and nothing that looks like a recession in the very near term.
So how do you put that into a portfolio? Because a lot of people have been looking at some of those factors that you named, the fact that maybe things are softening up, but the economy is still strong. We're going to see the Fed finally start its rate cutting cycle. And that screens bullish for small caps. At least that's what we've heard on this program. How are you feeling about the state of the rotation right now and the durability of that?
Yeah, so the small cap story is really complicated. A lot of people get themselves very excited about the fact that, lower rates are good for small companies. And that may be true, but it's not the first or the second or perhaps even the third rate cut that really trickles through to the bottom line into their interest expense. And if we're cutting rates because the economy is softening, instead of like a stable economy with just prices coming down, that's a different story for small companies. I'm a little bit less constructive on the fundamentals, and I would note what's happened during the course of earnings season when analysts have been revising down their small cap earnings expectations as companies reported, which is a different trend from the large space. I understand the rotation. I understand people wanted to even out positioning. But I don't think there's a huge fundamental driver for the small company space at this point.
So that's the size story. What about the sector story, too? Because you've also seen it within the large cap space as well. Those underloved sectors, financials, healthcare, energy, et cetera, also catching a bid there. Does that make more sense?
I think we're at the end of the technical part of this rotation, and a lot's going to be dependent on what happens in earnings, not just this week, but next week, which is also a huge week in terms of reporting. Look, I think it's critical to see what happens to tech earnings. If we end up getting solid tech earnings and the guidance is not just stable from where companies had guided, in the first quarter, but actually perhaps raising and talking about areas of potential revenue growth, I think that will get confidence back in. But right now, people are worried that there's been too much price performance and not enough action. And this is kind of a show me earnings season, in my view.
I'm wondering what to make of those big tech names. A lot of people are asking, where does the rotation come from?
Yeah.
Does it come from your cash holdings, or does it come from taking profits out of those high flyers and pushing them into other names?
I think it comes from taking money out of these high flyers. We're actually saying, after a phenomenal first half of this year, taking a little bit of profits, thinking about balancing out your risk, and just understanding that in a second half of the year where, earnings are going to be very important, central banks are going to be moving, and there are critical elections and geopolitical risks, you just want to come in at a more neutral stance than most people were, let's say, in May.
What about regions? I noticed that you like Japanese equities, and I feel like that's a new thread that we're starting to see in terms of performance.
Yeah, I mean, outside of the U.S., Japan is our largest country overweight. We've had that position on for a number of months at this point. And we're kind of playing this both through single names as well as through index exposure. Look, we think there's some positive momentum in Japan. Like in the last 25 years plus of my career, there have been a lot of times where people gotten excited about Japan and it just never followed through. But we're getting that little bit of inflation, we're getting that little bit of growth, and we're seeing more optimism on the part of the Japanese companies. Plus, there's some good fundamental stories in there as well around industrial automation and supply chain shifts and the proximity.
Those are the things they do well.
There's some things that they do really well, exactly.
What about the yen? I mean, I know I've been looking at Japanese products a lot more lately. Obviously, 150 yen to the dollar makes it a lot cheaper. Is that a real tailwind, you think?
I think it can be, but we also need to be conscious that there may be some intervention at some point. I'm not an expert on the currency side, but we are really thinking about how we want to hedge or not hedge our currency given the fact that we are at 150.
So let's stay international too, and let's talk about Europe because it seems like you're overweight to consensus on Japan. Not the case when it comes to European side, though.
Yeah, no, I think in Europe you need to be a stock picker. There's so much in the index, frankly, that doesn't look great. Or the great companies trade at this massive premium valuation to everything else, like 30% to the rest of the market. And on that front, you just have to ask yourself, is this the point in the cycle when you want to buy the massive premium? I also don't love how little tech exposure and how little kind of innovation there are represented in European indices. So we need to be really conscious of that. That is still our core belief that technology and spending on technology are going to really drive the market higher, even if we have some more indigestion in the near term. Although I must say, I'm quite cautiously optimistic about earnings this week for those big four.
All right, we're going to talk more about that with you. Stay with us. Kate Moore from Blackrock is going to hold over. Another quick check on futures, though, this morning. After a drop in the equity indexes, at least the S&P, last week, it was down almost 1% last week, the second drop in a row. We see gains to kick off this week. Up only about 1/3% on futures, but NASDAQ futures are up higher as we await these big tech earnings. I'm not sure about the rotation today, but there's the Russell up 0.3%.
Still higher.
It is still higher. That's true. We'll talk more about those big, giant, mega cap companies next. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. President Joe Biden will call for lawmakers to pass new binding ethics rules and term limits for Supreme Court justices today. The move comes as the latest part in a sweeping proposal that would fundamentally alter the United States top court. And the sabotage story continues in France. During the Paris Olympics, a number of fiber optic cables carrying broadband services across the country's southern and eastern regions were cut overnight following a massive attack last Friday on the country's super-fast rail infrastructure. Connections serving the capital, however, where the Olympics are being held, weren't affected by the latest disruption. And political tensions are ratcheting up in Venezuela after President Maduro was declared the winner of Sunday's election. An exit poll conducted by U.S. firm Edison Research found that Maduro's opponent, Edmundo Gonzalez, had won by more than 30 percentage points. The opposition called on the military to enforce what it called the will of the people.
And there's a big week ahead for tech heavyweights. We're going to get results from Microsoft, Meta, Apple, and Amazon. Kate Moore of Blackrock, she's still with us. She has an overweight position in tech and AI. And just before we went to break, you talked about a cautious optimism about this earnings week.
Yeah.
What happens if they miss?
I'm not worried so much about the miss. I think the real focus here is on the guidance, because that's what most people have been worried about, is not whether or not we had a strong second quarter, but do companies feel confident about third, fourth, and the beginning of 2025? It's going to be a real show me moment from the guidance perspective. I think people are anxious given the price performance in the tech sector and the AI and AI adjacent names over recent weeks. and have kind of said, is this the end of the trade? We think we're at the very beginning, frankly, of the spend in this space. People who are frustrated and uncomfortable with the fact that there's been an enormous amount of spend, but we still have an enormous amount more to go in order to really embed this technology in all of our different businesses, need to just kind of take a breather.
Hang on, don't you put any hedges against a miss? I mean, we've seen huge punishments for light misses so far in this earnings season.
Yes, in fact, we've been adding to our hedges over the course of the last couple weeks. That said, we haven't been drastically slashing to underweight all of these other single stock positions. We've been cutting tech a little bit since the kind of the peak we had in the mid-late spring from a risk management portfolio construction perspective, but we still feel convicted that this is going to be the most powerful theme over the next couple years.
So I want to go back to the Show Me story because we were speaking to Larry Adam from Raymond James last week. He made the really interesting point that you want to be where companies are spending money, not necessarily the consumer. And obviously companies are spending money on tech, on AI. But to your point that this is a Show Me story, it feels like the market is really coming to grips with the fact that that ROI is going to be much further off than maybe first expected when it came to AI. I'm wondering how you're thinking through those different components there.
Yeah, that's exactly right. There's this anxiety on the return on investment right now. And I think it feels a little bit misplaced to me, to be very honest with you. I mean, we are, just a few months ago, we're talking about how we were at the early innings, to use the baseball analogy, early innings of the spend. And then 3-4 months later, people are like, why isn't this working yet? There has to be a little bit of patience, especially with these big structural shifts. This is technology that's going to disrupt every industry, hopefully improve efficiency and productivity. And companies need to spend and build before we can actually see those use cases, and deliver to the bottom line. So I'm not giving up yet.
Not yet.
Kate, what about outside of the big tech names and into the semiconductors, into the chip makers? You look at Intel reporting earnings this week, has taken a real hit this year. On Semiconductor reported this morning, just soaring pre-market. Where do we stand in that part of the sector?
Well, I think this is a great example. There are winners and losers within the semi space, right? And if you are in the right space and you're seeing demand continue to accelerate, you're great. If you are kind of in an older business and you're not innovating and keeping up with where demand is going, you're really going to get punished. I think we're going to see more of that this week, too, with all of these earnings, is that, if you meet numbers and raise guidance and show a level of confidence, the market's going to reward you. And if you don't, you're going to get really punished.
There are winners and losers in every space, but do you go to data centers around AI? Do you go to power generators, utilities around AI? Are there certain segments of this business that you think you want to get in early?
Yeah, everyone was rotating into the utilities and into the, power suppliers for data centers, but that's a little further off. We're still in the buying chips and building kind of phase. So that's kind of my favorite place within the AI theme. But I was thinking about this as well, as we're talking about these winners and losers and big, market reactions to earnings. It is a great environment for active managers and for people who are trying to generate alpha. But you have to be on your toes. It's not a set it and forget it kind of market.
I do want to go back to that point, though, about where we are in the AI investment cycle, because that's something we think about and talk about a lot. So still buying chips, sort of the picks and shovels of AI. Too early to invest in some of maybe the data centers, power providers. If that's the case, I have to imagine it's too soon, too, to pick winners when it comes to the actual applications of AI as well.
Yeah, I think that's right. But what people are listening for as companies outside of the tech ecosystem report is, do these companies think about their AI and technology strategy? Are they saying, this is how we think we'll be able to use this technology, this is how we're setting up our infrastructure to try? If you don't have a strategy and you just say, hey, I think that's something of the future, then everyone is rightly concerned. They're going to get left behind. Within each industry, whether it's consumer or industrial, energy, any sector industry, if you don't have an AI strategy and a technology strategy, it's a reason for concern.
Kate, you mentioned a little earlier you've been increasing your hedges of late. How do you hedge this market?
So we use a lot of options, and I've been doing stuff on single names as well as on the index level. We are very active in our fund relative to, say, a more traditional mutual fund in hedging and being very tactical around volatility and big events. I've done some stuff across the semis and technology space more recently. Again, not selling my core positions, but just trying to do some prudent risk management and looking for opportunities when vol gives us that entry.
And I mean, just really quickly before we let you go, the sort of the fact that you hedge single names, you hedge the benchmark. Are you sort of switching that dynamic? I mean, what does your single stock hedging look like right now relative to just looking at the benchmarks?
Yeah, look, it depends on what individual positions are. If we have an opportunity to kind of overwrite something, if we have an opportunity to kind of sell puts on something we want to continue to hold but take in a little bit of premium, these are kind of strategies we might use. Or if we think things are going to be in a tight trading range, we'll use that as an opportunity as well.
Kate, it is great to see you. Really appreciate you stopping by to help kick off the week. That, of course, is Kate Moore of Blackrock. And coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next, this is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Quick check on where markets are headed. Just about 6 minutes away from the opening bell. You can see S&P futures are up to kick off the week, just about 0.25%. NASDAQ 100 futures up a little bit more than 0.5% right now as we await the big tech earnings. Russell small caps gaining as well, just 0.2%. But definitely better than last week, which was down, Katie, I think about 0.8% in total.
All right, there you go. It's time now for Social Climbers, the companies making waves on social media this morning. And first up, ARM Holdings under pressure on some analyst action. HSBC downgrading shares to reduce, pointing to fresh cracks in the AI narrative. Next up, take a look at shares of Alibaba, moving higher in the pre-market after announcing plans to raise service fees for its clients. And finally, McDonald's kicking off a busy week of U.S. earnings, results falling short of analyst estimates, posting its first quarterly decline in global sales since 2020. And this is an interesting one, guys, because they did introduce that $5 meal special, but not until so late in the quarter that it's not quite showing up yet.
Yeah, it was only the last week that you could get that. And part of the problem is the price of, the traditional Big Macs have risen. Although they've introduced some new products here, Sonali, I'm looking at the Bacon Cajun Ranch McCrispy.
But how much does that cost?
It's whatever it is, it's too much for me.
You know, it's interesting. After market tomorrow, Starbucks reports, and a big question about how much people are trading down. Now, will Starbucks give you a cheaper option is what I wonder.
And Wendy's got to stay premium. You got to find a Starbucks first. Or a Wendy's. Neither one is around here.
That's true. But Wendy's does also report this week. And I have to say, I'm more of a Wendy's gal. So we'll see.
More on earnings next. We're going to speak to one of the biggest bulls on Wall Street. Stick with us. This is Bloomberg.
We are moments away from the start of trading. After back-to-back weekly losses, we kick off this week with futures higher. I'm Matt Miller. This is Bloomberg Open Interest. Just about 16 seconds to go. You can see S&P futures up. It's fairly tepid, only 0.3%. We're awaiting all of the big mega cap tech stocks reporting this week. I shouldn't say all, 4 of the big mega cap tech stocks this week. So that's what we're focused on, along with the Fed, the BOE, and other central bank decisions. You heard the opening bell. You see Kane Anderson on the New York Stock Exchange. Over on the NASDAQ, we see Alaris celebrating their 5th anniversary of a listing. Let's get over to Katie Greifeld. She's got a look at the early trade. Katie?
So far, a few minutes into the trading day, you can see currently there's green on the screen, tepid as Matt called it, but the S&P 500 up about 0.3%. Big tech leading the way so far. NASDAQ 100 up about 0.5%. Your small caps, not exactly a rotation, but a broadening out today because the Russell 2000 currently up about 0.3%. But one stock to keep an eye on at the opening bell, that's on Semi. Shares really advancing right now after the semiconductor device company reported second quarter adjusted earnings per share that came in ahead of estimates. Shares currently up about 9.4%, Sonali.
Katie, I'm keeping an eye on crypto-related stocks. Coinbase, Riot, Marathon Digital, all rallying. Republican nominee Donald Trump over the weekend, you may remember, expanded his supportive rhetoric of cryptocurrencies, shifting away from being skeptical of the digital assets. Coinbase up nearly 3%. Riot up more than 5%. Marathon Digital also buying more Bitcoin, by the way, up almost 5%.
Getting ready for a big Bitcoin buildup. Also, McDonald's sales fell for the first time since 2020 on a quarterly basis on lower than expected growth. That's clear because sales fell. Let's get a closer look at McDonald's stock right now with Bloomberg's Abigail Doolittle. Abby?
Yeah, Matt, it was a miss right across the board, basically, for McDonald's. Right now, the stock down slightly. Earlier in the pre-market, it had actually been up about 0.5% to 0.6%, perhaps on the idea of less bad. But we since then have had, and now flipping slightly higher, commentary for the company on the call. Not so great. They are saying that the backdrop right now is more difficult than expected last year. Demand is falling among low-income consumers. They also are seeing a negative third quarter comp across all segments. So not so great, but one reason that we may not have this stock plunging, or even it was higher earlier, if we put McDonald's into the context of the other indexes on the year, what we're looking at here in white is the S&P 500 up about 15%. The restaurant index down about 10%, and there's McDonald's down closer to 15%. So we have some real underperformance here from McDonald's on a stock price. Sonali, I would say that a lot of this weakness is priced in. However, if this weak commentary continues, keep an eye on McDonald's. It could really be a tell on rising prices, stretched budgets for Americans and, frankly, people around the world. This could be a good tell on the state of the consumer.
Abby, thank you so very much. Of course, that is Bloomberg's Abigail Doolittle. And joining us now, John Stoltzfus, Oppenheimer Asset Management Chief Investment Strategist, one of the biggest bulls on the street. And you take a look at McDonald's this morning, for example, Starbucks tomorrow, then Wendy's, and of course, a horde of big tech earnings. Where are the weaknesses of this earnings season? Are there places that even you are now shying away from?
Well, we'd have to say that where the weaknesses are is pretty pronounced. If you look at the EA page, you've got energy so far. Earnings growth is down negative 14.23%. Real estate negative 14.63%. And materials single digit down, but at negative 6.05%. Of course, we're still early in this midway through the earnings season. So we'll have to see what happens. But overall, you've got four sectors last I looked that have double-digit earnings growth, and it's a combination of things like tech, cyclicals, and I think at least one defensive sector, as I recall. So all in all, much like we would expect, this is transitional into a new normal.
And John, it feels like a real make or break week when it comes to the rotation trade, the broadening out trade, whatever you want to call it, because, of course, it's been a while since we've seen big tech report, obviously, and it feels like every quarter a lot of these companies come out and sort of shock the markets with these big numbers, and then suddenly tech is back in charge and leading the market. This time around, are you expecting a similar dynamic?
I think, to see mixed results come in from an area that's been particularly hot is not surprising as we go forward. We've seen it in areas with financials and the process of the recovery. And we've certainly seen it, of course, in technology. Traders tend to throw down anything like a hot potato on disappointment. But the reality is it creates opportunities for people to really dollar cost average, gain exposure, stuff that may have been a little bit too expensive before. This looks to us like a relatively healthy rotation, rebalancing, with likely tech to remain in the leadership, though giving back some of those gains on profit taking by bears, nervous investors, and investors who just want to take a little cash off the table, maybe build a shopping list to look for any babies that get thrown out with the bathwater on day-to-day trading.
So, John, we've been kind of waiting for a rotation in earnings as well. Our own Gina Martin Adams at Bloomberg Intelligence has said that, we're going to see not as much spectacular growth from the Mag 7, whereas the S&P 493, as she calls the rest of the market, had been in an earnings recession and we're starting to expect growth from them. What's your earnings outlook, going through the rest of the year for these other companies?
Yeah, we think we're going to see improvement there. One of the best interviews I've seen lately on Bloomberg was David Rubenstein's interview on July 25th of Fed Chair Jerome Powell. And Jerome Powell very clearly gave credence to the thought that, things are really are improving both on the inflation front, as the Fed brings inflation down now, 11 hikes and 8 pauses thus far. And at this point, really, they're looking at the jobs market, and that remains remarkably resilient. We won't say robust, but if you look at the JOLTS numbers thus far, we'll have to see what it comes in this week. But all in all, it points to resilient consumer, resilient business, not robust, but resilience. And in effect, jobs showing resilience. The people have, there's mobility and labor remains relatively tight. We're going back to where we were just before the trouble began in 2019, which was not a bad period.
John, you're calling out the Rubenstein interview. It reminds me of a Matt Winkler column that I read a couple of months ago, in which he quotes Jamie Dimon saying that the economy, Jamie Dimon says, basically it's booming. And then we got this 2.8% GDP number last week. We were looking for 2% flat, and a lot of people were more bearish than that. Is the economy maybe too strong? Is the labor market maybe still a little too tight for the Fed to start meaningfully cutting rates this year?
We'd have to think that actually we think the Fed is likely, we think with greater certainty that the Fed will cut 25 bips at a time, once in November and once in December. It will avoid having its critics saying that it's politically motivated if it cuts in September. And also just gives the Fed a little bit more leeway or space to judge how confident it can be when it starts cutting rates. So we think the end of this Fed funds hike cycle, boy, that's a tough one to say, is in sight. But it will require some patience, likely. And we could see, by the way, some of the rally that we've seen in smalls and mids be given back if that September cut doesn't happen. But that call for smalls and mids will likely be reiterated and rewarded so long as the Fed cuts in November and December.
John, we thank you so very much. Happy Monday to you. That is John Stoltzfus of Oppenheimer Asset Management, of course, on the start of a very busy earnings week and busy week for central banks. Now, I want to bring you a check on Enstar Group, a merger Monday, or mergers and acquisitions Monday, rather, for Matthew Miller. Shares are down more than 6% here, interestingly enough, after it agreed to be acquired by a group that includes Sixth Street being the leader of the group, Steve Mnuchin's Liberty Strategic Capital, and J.C. Flowers. Stock is down, interestingly enough, below the offer price of $338 per share.
What does that mean?
There's a go shop provision, which I find interesting as well. 35-day go shop provision to this deal in particular. Let's see where this goes. That means that this is a live deal. But of course, this is a restart of that private equity industry. This is a $5 billion deal in all cash. We'll keep an eye on this market as it goes along.
Yeah, it's interesting, of course, to see shares drop, as you pointed out. And interesting, too, that you're seeing McDonald's actually rise a little bit. We're going to get more on McDonald's as sales drop, actually, for the first time since 2020. The analyst take coming up next. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Here's a quick check at what's going on in stocks right now. Just 13 minutes into the session, we're still up about 0.25% on the S&P 500. The NASDAQ 100 up 0.7%, and the Russell 2000, the small caps, are just basically unchanged.
Yeah, faltering a little bit on the small caps. We'll keep an eye on that, but it's time now for our top calls. Some of the analyst action in focus this morning. And first up, Tesla rising as Morgan Stanley names the company its new top pick within the U.S. auto sector, replacing Ford. Analyst Adam Jonas is maintaining his overweight rating and a street high of $310 on the stock. Next up, Barclays downgrading Bristol Myers to underweight. The analyst over there says that the company's persistent broader challenges remain even after the recent rally. And finally, we have Philips Securities upgrading Alphabet to a buy. The firm cites online advertising resiliency and an attractive valuation. Now, we also want to talk about McDonald's because shares actually up on what analysts see as a better than feared U.S. sales report. Quarterly sales, they did fall for the first time since 2020. So let's unpack this all with Michael Halen. He is senior restaurant analyst over at Bloomberg Intelligence. And it's really interesting here, Michael. Again, we did see that big, scary headline number, maybe better than feared on some of the sell side. But how are you unpacking this report?
Yeah, to your point, results weren't great, but it was expected, right? Lamb Weston results and their guidance over the last few months has been pretty dismal. We know obviously McDonald's sells a lot of French fries. Industry level data, we use Black Box Intelligence, our great partner of ours, have shown weak results throughout the second quarter. Really didn't get a boost in restaurant spending that a lot of analysts and management teams really expected. And results have weakened into July. So, them saying that their results are still negative but in line with June, maybe even can be looked at as a small win here.
How much can the $5 value meal help them at the end of the day? Michael, I don't want to draw a stark comparison here, but you thought about what Red Lobster did to try to trade down in a massive way. Well, how far can you go is what I'm really asking here.
Well, they seemed optimistic, right? They said it's boosting traffic, but not sales yet. So I guess they're getting some sort of a mix shift. Some people that maybe will go to McDonald's and wouldn't order the $5 meal are being, enticed by that such a low price point with a pretty significant amount of food. So, they were positive because they say traffic usually comes before sales. But management admitted on the call that they're going to need to do a bigger revamp in the United States to really move the needle. That the 1, 2, 3 value meal isn't resonating with consumers. They've gotten a lot of shade online about the fact that you can't get an item for $1 or less on that menu. And so the real focus is going to be reworking that 1, 2, 3 value menu to have those low-income consumers that are struggling right now come back to the stores.
I could see myself going for a Bacon Cajun McCrispy and a Grandma McFlurry, Michael, because I make bad life decisions and I am weak. I have low willpower. But if I were able to get hold of some Ozempic or whatever the hottest flavor of that is, I'd be able to avoid that stuff. Do you see any of that coming through in the results?
Yeah, it's hard to parse that out. I think the impact from that is pretty minimal at this point. Over time, it could be more of an impact. What we're looking at is, maybe at some point when Ozempic can be acquired in pill form, we think there'll be some wider adoption, right? But, to your point, two places that people are looking at are definitely fast food and fatty food consumption, as well as alcohol consumption. But we're still kind of in a wait and see period right now.
Yeah, a lot to think about there when it comes to both Ozempic and also Matt's eating habits. But let's look to the rest of the week as well, because we also have Wendy's reporting, for example. You think about some of the challenges that McDonald's is facing. Do those also apply to Wendy's? Are these industry-wide problems at this point?
Yeah, they are industry-wide. So, in the past, at times when McDonald's has struggled, it's helped chains like Wendy's and Jack in the Box and Sonic. But we don't necessarily see that being the case this time. Like I said, industry-level data is showing weakness across the board, especially with low-income consumers. That's 30-ish% of all of the traffic at quick-service restaurants. So there is some concern about Wendy's. The stock has not been doing well ahead of this print, and it's a big concern is that they haven't really had too much to compete in terms of a $5 deal with McDonald's and Burger King to this point.
Michael, thanks very much. Michael Halen there of Bloomberg Intelligence talking to us about McDonald's results out this morning. Revenue fell quarterly for the first time since 2020. Coming up, Vice President Kamala Harris's war chest. In just 1 week, she's managed to raise $200 million. That's 2/3 of what the Trump campaign raised in an entire quarter. We'll look at that next in today's Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. Let's take a look at the stock market right now. You can see we're higher, tepid though, to borrow a phrase from Matt Miller. The S&P 500 up about 0.2%. Big tech still going strong ahead of a pivotal week. The Nasdaq 100 up about 0.7% in Monday's trade. And it's interesting, the small caps, we were higher, matching the S&P 500, giving back some of those gains right now, though, Sonali, pretty much unchanged when it comes to the Russell 2000.
Switching gears now, Katie, time now for the Wall Street beat, because after her first week as a 2024 presidential candidate, Vice President Kamala Harris has raised $200 million. Her campaign says 66% of her fundraising tally came from first-time donors. Joining us now is David Gura, host of Bloomberg's Big Take. And you think about where that money is coming from. What does it say about what the campaign is going to look like at the end of the day? The dollars are large.
Yeah, they've managed to capture a lot of enthusiasm and a lot of money as well. And what we've seen these last few weeks is her really traveling a ton, certainly by comparison to Joe Biden when he was the candidate. And her husband, Dorf, is in Martha's Vineyard today. He's going to host two fundraisers as well. So you're seeing, again, this effort to get people who were sitting on the sidelines to come in and donate money, but also this overture to high-dollar wealthy donors as well.
The interesting thing to me is that it's not the same old people, donating money to the Democratic Party over and over again. A ton of the money, I think even maybe the lion's share, is new donations.
New donations, and this kind of mirrors what we're seeing in the polls, which is, a couple of weeks ago, it seemed like there were a lot of people who were undecided, who were unenthusiastic about participating in the election. They're now showing more enthusiasm, and that's really like who the campaign is homing in on, trying to get them to come and be donors as well.
So, of course, we've seen this big burst, but this comes after a lull of Democratic fundraising. And are they expected to keep this momentum going? Or, again, is this just sort of a enthusiastic one-time sort of shot?
That's the hope. And so it's been just a couple of weeks, which is crazy to say. But, we've seen Kamala Harris's efforts at fundraising. Now she has to pick her running mate. And part of that is to certainly not forestall the momentum that she's had, hopefully to carry it forward even more. So part of that calculus that she's going through right now and picking that running mate certainly has to do with fundraising. And so, the governor of Minnesota, Governor Walz, is somebody who's the head of the Democratic Governors Association. He's raised a ton of money for Democratic governors broadly. J.B. Pritzker, another person who's kind of in that dozen or so people who are being looked at, of course, has a vast personal fortune and lots of connections as well. So it's not like the decisive element in all of this, but certainly something that she and the campaign are looking at as they make this decision.
Who are the front runners here? Because you think about what you see in Arizona, for example, Senator Mark Kelly and his expertise in the border versus Josh Shapiro over in Pennsylvania has a swing state. What's more important at this juncture?
Well, and don't forget Pete Buttigieg. I mean, Matty Iglesias on our Bloomberg Opinion had a great piece about how well he speaks and debates.
Yeah, he was on Fox News Sunday this weekend, and I think everyone comported himself really well in that appearance.
There's
really
amazing
batted down a lot of
shots from
criticism.
that
Amazing
yeah.
shots, and he's so good at that. He's certainly one of these 12 people who are being looked at. I will say the bulk of that list are governors. And so what we've kind of heard from the campaign is they're looking at people with executive experience. So you mentioned Governor Shapiro of Pennsylvania won his race by a wide margin, has proven himself to be an effective fundraiser and somebody who's comfortable on the national stage as well. Roy Cooper of my home state, North Carolina, seen as kind of a similar way, a centrist governor with a lot of experience. Kind of connective tissue through all of these folks is they've been attorneys general before in their states. Kamala Harris is one as well. So she has some familiarity with a lot of these governors, especially who have come up through that path.
Just quickly, let's talk quickly about the Republican side of things, because Kamala Harris over the weekend calling J.D. Vance weird, for example. That's a direct quote from her. And it just feels like, in general, he's come under some scrutiny. Yeah, and that's like very much a tack that the Kamala Harris campaign has been using, is trying to paint what Donald Trump's been saying as kind of off or strange or weird, as you say. I think that's going to continue. Look, Donald Trump was at this Bitcoin conference in Nashville over the weekend, delivered a big speech there that was kind of a mix of his stock and trade, usual boilerplate, getting into crypto as well. And he raised a lot of money on the sidelines of that, too. I mean, he had a fundraiser where I think the ticket went for more than $800,000 a head. So he recognizes, I think, the seriousness, like the way that the campaign has changed, the way that the donor game has changed as well. And so he'll be pushing ahead seriously in these next 100 days. It's crazy, just 99 days to go now until the election.
All right. Well, in some countries, that's a lot of time before an election, right? And maybe it's going to be a better thing for all of us.
I think that is. I mean, I won't say it's likely, but I think it'll bear some scrutiny.
Obama came out of nowhere, right?
That's right. I mean, there you go.
All right, David, thanks very much. David Gura, host of Bloomberg's The Big Take. You can check out that podcast on the Bloomberg, Bloomberg.com, wherever you get your podcasts, Apple, Spotify, whatever. Let's get to the trading diary, what you need to be watching this week. There's a lot. We get central bank decisions from the Fed, the BOJ, and the BOE. More big tech earnings rolling with Microsoft, Meta, Apple, and Amazon. Other notable earnings this week include Starbucks. And as Katie said, we get big oil results from Exxon and Chevron. Coming up in the next hour, we've got Katrina Dudley, Franklin Templeton, Public Markets Senior Investment Strategist. This is Bloomberg. Minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld.
And coming up, a trio of central bank meetings this week. We're going to get decisions from the BOJ, the Fed, and the Bank of England.
We also get earnings from a quartet of Mag 7 stocks worth nearly $10 trillion combined. Microsoft, Meta, Apple, and Amazon results all on deck.
And from tensions in Venezuela to Kamala Harris's growing war chest, we'll survey the latest in global politics. But first, 30 minutes into the trading day, let's get a check on these markets right now because there's green on this screen. The S&P 500 continuing to climb right now, currently up about 0.5%. The NASDAQ 100, take a look at that, up 1% ahead of a pivotal week for earnings. And meanwhile, that bond market rally continuing right now. The 10-year Treasury yield currently down by about 2 basis points, Sonali.
And it's the biggest macro week of the summer with 3 major central banks, the BOJ, the Fed, and the BOE out with decisions. Here to break it down is Michael McKee, Bloomberg's chief international economics and policy correspondent. And Mike, if you think about this week, yes, all eyes on the Fed, but if you think about the areas for the most upset, the way people are positioned, is it the Bank of Japan? Curious as to what you're watching for.
Well, it is the Bank of Japan. It could be the first one to move because the Bank of England's 50-50 and the Fed nobody thinks is going to move. But the issues are the same across the board. And you can see that all week in the economic data that we're going to get here in the United States. We get that JOLTS report on Tuesday and consumer confidence on Wednesday, ADP, the ECI, and we have the 2 decisions from the Fed and the Bank of Japan. Thursday is ISM manufacturing jobless claims and then the Bank of England. So it's Wednesday, Thursday for those central banks. And Friday, of course, July jobs. The markets will completely reprice on Tuesday and Wednesday, or Wednesday and Thursday, rather, after these central banks. And then who knows what the jobs report will do to market pricing after that. The one thing you want to watch for this week in terms of U.S. economic data in the jobs report is the unemployment number. It's 4.1% now. If it goes up another tenth, it triggers the Sahm Rule. So if the Fed is hinting it's going to cut in September, but the Sahm Rule comes into effect, then people are going to be concerned in the markets and they'll be raising questions about what the Fed is going to do. If you're looking for an impact, though, as Sonali mentioned, it is going to be the Bank of Japan, probably because they are expected to start a rate move up, unlike the other banks, and that should continue the move in the yen. Watch the yen for the reaction here. It has strengthened on the idea that they are going to be raising rates and that the Fed is going to be cutting rates, and we could see a much bigger move if indeed that is what we get on Wednesday.
All right, Michael, thanks very much. Michael McKee there talking to us about what to expect from central banks. Of course, we also have a ton of mega cap tech stocks reporting earnings this week, so it's very busy. Joining us to talk about all that is Katrina Dudley, Franklin Templeton Public Markets Senior Investment Strategist. Katrina, I'll start with the central banks. As Mike just finished there, we had an amazing GDP print. You know, William Dudley was saying in an op-ed last week, they've got to move these cuts forward to now. Can they be more sanguine about it?
I think they can, because it's not GDP that they're watching. They're watching inflation, and they're watching that unemployment number. And the inflation has continued to be sticky. And the fact is that we always know, and we've been talking about this for so long, is it's the last bit that's the hardest. It's like weight loss, you know, those final few pounds you've got to get off. Well, it's those final few basis points of inflation and coming down. So I think that the Fed has been really clear with us that they are data dependent, and they are not going to move in anticipation of that data. They're going to wait for the data to show up.
And there you go. And that explains why we've been on hold for almost exactly a year. You think about when they actually reached terminal. So, I mean, putting it together, weighing that against the earnings that we're getting. Of course, it's a very hefty earnings week as well. I mean, just super short term, what is the more important factor that you're watching right now? Is it the earnings picture or is it Fed watch?
Oh, it is earnings. But 78% of the companies that have already reported so far have actually beat earnings expectations. If we have a look at expectations and what analysts were doing going into this quarter, the rate of actually, downward revisions was lower than you'd anticipate. So the bar is actually higher, and we've still got 78% beating. We have 40% of the S&P, though, reporting. You're talking about the four out of the 7, that quartet. But it's really the other 493 that are reporting, and that's where we're actually focusing more of our attention on.
You look at these earnings seasons and they are so backward looking, and you think about how high rates have been, how high they might stay. What do you think the forward look is from here? How much more pain can we see if rates continue to stay high, if we don't see more than one rate cut this year?
I think in terms of the forward-looking of earnings, so I think let's just take a step back, because look what we heard coming out of Mark Zuckerberg about AI and the return on AI. And that's really been a big focus of the tech earnings, is whether or not we're going to see a return on those investments. And he made a really good comment where he said the risk of underinvestment is so much higher than the risk of overinvestment, and the market is focusing on those ROI numbers. So I do actually think that the market is forward-looking in terms of earnings. Rate expectations, though, if we get a cut, the question is, does that really help the low-end consumer? And that's where we've seen so much weakness in those numbers, is that low-end consumer is really feeling the pain, and they're feeling it in so many areas of their life. They're feeling it in their credit card bill balances. They're also feeling it, when they head into McDonald's or when they head to the grocery store.
Well, to that point, that's something that I've been wondering about is, we've raised rates above 5%, at least on the benchmark level. It really hasn't made a dent on the stock market. When it comes to the other end, I was going to ask, do rate cuts matter? Will it matter on the way down? But it sounds like what you're saying is maybe those smaller companies, those more consumer-facing companies, they do need a rate cut.
Yes, they do need some type of rate relief, because those smaller companies, number one, are more leveraged than their bigger counterparts, number one. Number two, when we think about the pull-through effect, some of these smaller companies need some of these rate cuts to help, spur some of the demand. And so finally, the other area where rate cuts help is, actually, we haven't been talking about this for well over a year, is on valuation. So think about some of the sectors that are going to benefit from rate cuts. Financials obviously are not, but look at biotech. We talk about that, and that's another area where you could see that, and you could also start seeing.
What, you mean because of discounted cash flows?
Discounted cash flows, but also think about the M&A outlook, and so looking at people being able to finance the M&A transactions. So I think that's the other positive side.
Where else does the rubber hit the road when you think about mergers and acquisitions? You see energy just booming in the last year. Is there more room to run there?
I think in terms of M&A, first of all, what does it do is it spurs cost cutting. And so if you've got a company that's subject to earnings pressure on a forward-looking basis, doing M&A, getting those cost cuts is a really good part of that transaction. And so I think that that's where we're expecting to see a pickup in the M&A environment that will be helpful.
What's the appropriate use of funds? You saw in the past week, people really look at the CapEx spending differently than they had in the past couple of months. You look at these big tech companies, do you want to see them putting money to work? Or is there a threshold here where enough is enough before they show you the money?
I actually think that it is that underinvestment which we continue to be cautious about. When you look at some of these AI investments, and I look at the AI use cases that we're introducing at Franklin, we're looking at things which are actually automating existing processes, but I'm looking at the next generation of products, of projects, and their productivity enhancing, and that's where really you get the benefits of this. So I think we just need to be
costly, right? I mean, we've been talking about Goldman Sachs saying, look, normally when we have a technological revolution, it's because something cheap replaces something expensive, right? The internet replaces labor, but here it's something very expensive replacing something expensive.
Yeah, but we can't have a replacement of labor because we just don't have any labor available at the moment. Number one, we've already been kind of doing all of those labor replacements. Unemployment is already at 4%, or 4.1. So I have a look at what's going to happen. Yes, you are right. Some of these investments are much more expensive, but what we've seen is probably an era of very cheap investments, and we're going to normal.
Really quickly here, How many rate cuts are you expecting for this year? We were talking to Kate Moore a little earlier, expecting as many as 3. Do you think we can get that far?
No, I don't think we can get that far in terms of rate cuts. I think that the meeting we're about to have it's out of the question. And then don't forget, we're going into an election cycle. We talk about the November date. We also need to talk about the Fed really not wanting to impact the results of the election. So we think maybe they can get one in, but that's about it. In terms of December, it is now a fair way away, and we're really going to be data dependent. But I am very cautious about the Fed being intervening too much ahead of an election.
Well, Katrina, sit tight for just a couple minutes. We're going to take a break and come back and get into all of it. But let's take a look at what stocks are moving underneath the surface right now. We're going to do that with Abigail Doolittle.
Well, first up, Katie, let's take a look at the shares of Abbott because they are down sharply, down 4.4%. This after a jury verdict awarded the plaintiff $500 million. So basically a $500 million verdict against the company around their potential knowledge, the jury thinking they did have knowledge about a premature baby formula that has the possibility of being fatal. So this stock is lower on this. Taking a look at what's working to the upside, though, of course, Republican nominee Donald Trump. He this weekend was more bullish on the crypto space, a real about face. On this, we have Bitcoin itself up 1.1%, 2%. We'll be taking a look at that chart in a little bit, and then take a look at the rest of the space. Ether also higher. However, at this point, it's interesting to see. We've just had this little bit of a turnaround for Coinbase and MicroStrategy, up a lot earlier, now flipping to the downside. Maybe the rally's getting a little bit tired. And then finally, speaking of the rally, let's take a look at Tesla. After last week's little bit of a messy quarter, but long-term good. This stock up almost 6%. Morgan Stanley jumping on the bandwagon, naming Tesla as its top pick. What makes this so interesting, Sonali, they're naming it as the top auto pick. I think that Elon Musk made it pretty clear in the last earnings call that this is an autonomy play, an AI play, so more of a tech play, but they like it as a car maker.
Abigail, we thank you so very much. Now coming up, it's the busiest week for earnings season. 27 trillion worth of companies reporting globally. We're going to talk more about what to expect next. This is Bloomberg.
Now let's get to high interest to look at what's making headlines around the world. First off, Bitcoin getting closer to its all-time high after former President Donald Trump expanded his pro-crypto agenda. The Republican presidential nominee pledged at a conference for the cryptocurrency to make the U.S. the crypto capital of the planet and to fire Gary Gensler if he returned to the White House. Lamborghini reported record results for the first half of the year, while most of the rest of the auto industry is struggling with declining sales, lowered expectations, and plummeting stock prices. The Italian supercar maker credits the company's full order books and healthy distribution worldwide as it is taking what it calls a balanced approach to EVs. They don't have any. Political tensions are ratcheting up in Venezuela after President Maduro was declared the winner of Sunday's election. But an exit poll conducted by U.S. firm Edison Research found that Maduro's opponent, Edmundo Gonzalez, had won by more than 30 percentage points. The opposition called on the military to enforce what it called the will of the people.
And more big tech chip stock earnings roll in this week. Microsoft and AMD report tomorrow, followed by Meta and Qualcomm on Wednesday, before Apple, Amazon, and Intel round out the week off on Thursday. And here to tell us what investors are watching for is Bloomberg Technology co-host Ed Ludlow. What are you looking out for? I mean, there's such a slew of earnings here between chips and big tech. Where is there most room for upset?
Yeah, I think largely driven by what we learned from Alphabet, the parent of Google, last week. The market basically doesn't believe that any of the companies, be they on the infrastructure side or sort of all-out AI play, have a good formula for every dollar that comes in or gets spent on infrastructure, how many dollars come out. So if you look at Alphabet, for example, their expenditures guidance was $1 billion above what the street said. And when I asked Ruth Porat on the phone, do you actually have a number you can give us on how much money you've made from generative AI? She said, I'm not going to answer that because we'll answer it on the analyst call. So we all waited with bated breath. And the answer on the analyst call was, year to date, we've made billions of dollars through our cloud business, and didn't say anything further. And that was a real letdown. And that same story is applicable to Microsoft and Amazon as well, particularly in AWS. The math just isn't mathing straight away.
All right, Ed Ludlow, actually in NYC this week, but on the other side of the studio. But we'll see you tomorrow. We'll have you at the desk then. That is Ed Ludlow. He is the co-host of Bloomberg Technology. But let's get back now to Katrina Dudley. She is Franklin Templeton Public Market Senior Investment Strategist. And when we think about tech earnings and the focus on AI, we've seen interesting pushback on the AI spend. I mean, you think about where we are in the sort of the investment cycle for AI, and it seems like we're hitting a little bit of a pause.
Look, we know that some of these gains that are coming from AI are making people more productive and doing their job better. But because the unemployment number is at 4.1, companies are just holding on to labor. So when they get the gains from AI, they're actually taking those gains and redeploying the assets. And where are they going to redeploy them? They'll redeploy them into revenue generating areas. So it'll help the top line. It won't necessarily help in terms of cost cut. It's really easy to measure cost cutting and what the benefits of me taking out a person. It's much more difficult for me to measure taking a third of your time and redeploying it into client engagement and revenue generation. And I think that that's where...
Also hard for Ruth Porat to measure, apparently.
I think Ruth is an extraordinarily smart woman, and I think that she is trying, but I think that they're struggling because it's very difficult to, with these senior people who have just got these jobs where you can't exactly time measure the value of what's been, the productivity and what you're creating there. So I think that she's deliberately not putting numbers around it, but I think it's just the nature of these type of gains.
Well, when it comes to AI, we keep hearing that we're in the early innings, but there was a really interesting note from RBC over the weekend from a client conversation pointing out that in 2000, we all thought that e-commerce was going to be how people shop. You fast forward to right now, and it only accounts for 20%. And I'm wondering whether we could see something similar unfold with AI, whether there should be sort of a re-rating of expectations here.
I think AI actually is a long-term journey, and we're actually not in the early innings of AI. We're probably close to like the first third. We've been using AI in our lives from something as simple as Siri. My kids talk to their phones. They don't use the keyboards like I grew up with on Blackberries. And so we've been using it in various degrees. It's just now much more iterative and much more pervasive and much more CapEx intensive as we see it this time around.
Can I just push back on that e-commerce figure? Do you think we only do 20% of our shopping online? Like, honestly, how much stuff do you buy in real life compared to online?
It sort of depends on what you're buying, because I buy all my food in person, for example.
Oh, you still do that?
I do.
Okay.
I also spend way too much money at CVS across the street.
Doesn't it seem like, Katrina, we spend a lot more of our shopping online than 20%?
I think the thing is you've got to bifurcate it, because if I'm going to buy a car, I can tell you, yes, I know you can buy it online, but I really want to drive it. I want to feel how it turns and everything. And so those big ticket purchases, I think, are really difficult. You can do cost comparison shopping, and I think we've seen a lot of that, but the actual final purchase does happen in person.
I think it's a really good segue to talk about the consumer-focused stocks. We had McDonald's this morning, didn't look so good. We have Starbucks tomorrow. We have Wendy's this week. A lot of bifurcation among the consumer, and University of Michigan sentiment data showing you that things are not looking so great. How do you think about the read-through to the stock market?
I think in terms of the consumer sentiment numbers, it's really interesting. The near-term consumer numbers have been coming down across the board. It's actually the longer-term consumer outlook is relatively stable. So people are actually optimistic in the longer term. It's just those near-term pressures. We've been hearing from McDonald's for some period of time that they are concerned about the low-end consumer. That low-end consumer is really adjusting their spending, and McDonald's, though, is responding. They're bringing in cheaper menu offers, options. They're extending those out through August, the $5 meal deal. So they're responding, and that's what we like to see companies do. In terms of the rest of the market, though, we're seeing some pockets of strength, like Lamborghini's earnings, which we mentioned. If you have a look at Hermes, the Birkin bag has been really strong. So we still have pockets where the consumer is okay, but and when you look at the numbers, yes, it's easy to focus on the low-end consumer. They are a large populace, but in terms of their impact on spending, it's not quite so great.
All right, Katrina, great having you here on the program with us in studio. Thanks so much for joining us, Katrina Dudley there of Franklin Templeton. Still ahead, Vitol's profit boom. We'll look at how the energy crisis led to a record $6.5 billion payout to the employee owners. This is Bloomberg. Vitol paid a record $6.5 billion dividend last year to its employee owners. It's the latest evidence of how the energy crisis has delivered spectacular riches to the world's commodities traders. The payout represents, if you average it out among the 450 employees who own the company, $14 million each. Bloomberg, the Close co-anchor Alex Steele joins us now. She's also a resident energy expert. So
it's a lot of money.
It's a lot of money to get paid. I mean, I'm sure they didn't divide it evenly among all 450 traders, but some traders got really, really big paydays.
Yeah, it also just pays a lot of money to move stuff around the world and then bet on that. So the reason why these guys, and it's a Gunvor, it's Mercuria, it's Trafigura, and it's Vitol, is that they see everything. So they move stuff, literally stuff, commodities, LNG, energy, you name it, around the world, and they also trade on it. So they get to see a lot of stuff, and then they get to trade on it, and therefore it makes a lot of profit. A couple things is that a few traders have sort of been brought down due to bribery cases across the board from all of these guys. And also, you're benefiting off of crises sometimes. Not always, but in the issue of the Ukraine war, you're making money off of a crisis, and that doesn't always look good.
So, of course, a big week for energy in general. We, of course, have this breaking story when it comes to Vitol, but it's also reporting season for big oil as well. You think about what we're going to learn on Friday from the likes of Chevron and Exxon. What's the general thinking about how they're going to fare this past quarter?
I actually love this question because it does tie into some of these traders, too. Because these traders that are private, that make boatloads of money, are making investments into energy transition things. Like Vitol just made an investment into a power generation company, right? They're also looking to go back into metals like copper that they feel are really important for the energy transition. Now you fast forward to big oil, they're trying to figure out how to allocate their capital in the correct way, right? They still need to make a lot of money when it comes to producing oil and gas. They also have refining businesses, some of them, which has been under pressure right now. And they also need to figure out what policy is going to be like and where to invest for things. They're not power companies. They're not hydrogen
need
companies.
A lot of money to get that done. Are the capital markets there for them at the end of the day? You think just last week, Occidental, did a large bond sale to make an acquisition work out. But what about the look forward?
I mean, in terms of capital markets, I mean, some of them don't really need it. Like, I would argue that, like, an Exxon might not need that, but we're going to talk to the CFO about that on Friday. In terms of, I don't know the answer to that question, to be perfectly honest with you. I do know that in terms of getting shareholder interest, you need to be the best and the biggest. And that if you're like a smaller guy, you need to get that investment. You need to say, hey, if you're going to own one energy stock, you need to own me and not these 17 other ones. And that gets even more interesting as we continue to see M&A.
How do I get a job trading oil for Vitol?
I don't know. I'm on their call list. I want that job. But, you know, I mean, obviously they're going to say this, but Russell Hardy is the CEO, and he's like, we're not all motivated by money. We like the job.
Alex, we got to leave it there. We thank you so much. Looking forward to seeing you later in the week. And coming up, we're going to switch gears. We're going to look at the strength of the U.S. economy. We're going to talk to the North American CEO of Saint-Gobain next. This is Bloomberg.
We began the hour with a look at the week ahead in economic data. It's going to help us make more sense of the U.S. economy, but it has been growing, as we learned last week, to the tune of 2.8% on GDP. That was much more than had been anticipated. Let's hear from someone who participates in this economy every day. Saint-Gobain designs, manufactures, and distributes building materials for commercial and residential construction, obviously a huge part of the economy. The company's results last week showed that its North American business continues to lead the way for the group. Its North America CEO, Mark Rayfield, joins us now. Mark, thanks so much for your time. Let me get first off, your take on the economy, on supply chains, on inflation. You know, this has been a real focus out of the pandemic. How does it look to you right now?
Well, first off, thanks for having me this morning. I think the economy has been very strong, as you mentioned, and we are continuing to see a relatively robust housing environment. We've been saying for some time now that the housing stock is underbuilt in North America, and we see that the general, even with interest rates at a higher level, the building continues to go at a steady state in North America, as well as remodeling, renovation. So supply chains have loosened up. Inflation has settled down. We don't see as much inflation right now, but we still see very strong demand in both new build and renovation.
So what's your revenue breakdown look like then in terms of commercial real estate you're putting up versus, say, residential and multifamily homes?
We're certainly much heavier in residential. So we're over 2/3 in residential in North America versus commercial in North America. In that, the single family, multifamily, we're much more, again, probably 2/3 on single family versus multifamily there. And then if you take it one step further, we're probably 2/3 in renovation and remodel versus new build. So very diversified across the network.
Mark, what would a single rate cut begin to unlock, and where would the most opportunity be?
Oh, it's a great question. I mean, I think we've been talking about rates going up and down for some period of time. We've seen that housing, because there's an underlying fundamental need for housing, has stayed relatively resistant. I think there's some, with rate cuts coming down, 1 or 2 cuts, I think you'll see some people start to leave their homes. Right now, they're locked in their homes with very low interest rates. And in doing so, they're unwilling to sell their home and go to another house. And that's kind of kept the constraint of houses rotating. Hasn't stopped new build, but kept the houses from rotating, which has kept prices up on housing overall.
Well, that's kind of what I've been wondering about, the fact that you don't see people moving around, that this housing market has been kind of frozen, if you want to call it that. When it comes to the sort of breakdown that you have between new build versus renovations, I'm wondering if it's more sort of tilted to renovations right now, given just people aren't really moving and we have this undersupply of housing.
It is. I think renovation goes up and down a bit. You saw the huge surge in COVID. That's obviously calmed down a little bit. Renovation actually happens a lot when you start rotating homes, because when people are getting ready to sell a home, they renovate it to sell. People generally don't get exactly the house they want when they buy one. So after they buy it, about 12 to 18 months after purchasing it, there's another surge in renovation. So when houses rotate, we see a bigger input on renovation remodeling. However, you also see a significant impact now on severe weather events, which is forcing kind of a necessary renovation remodeling in lots of parts of the country as well. So there's a lot of dynamics in play. In general, what we see is just a steady, robust market. We think with an interest rate cut, it will just get stronger.
Mark, I do understand this inclination to rotate. You think that those higher income customers could get a more expensive home, but with the weaknesses you're seeing in the lower to middle end consumer, there's skepticism here that those customers can upgrade into a new home at this juncture as well. Even if rates come down, prices are still relatively high given the lack of supply. How much certainty do you have in that rotation?
I think I have certainty because there's always been that issue around when you upgrade from one house to another. So I think there's always that challenge when you go through that for all of us as we went through that process. So I think that still takes place. I think you've got a lot of homes rotating where people are kind of leaving and going to a single home in the Southeast or Southwest, retiring, so to speak. And that's what we've seen for movement in houses now, is kind of cash buyers cashing out of the house and then going down and buying homes there. I think as we'll see the new people entering the homes with a slight rate cut.
Mark, let's go back to your business, though, because North America, it's not just the United States. It also includes Canada. And when it comes to Canada, yes, you've made a lot of recent acquisitions over the past couple years. And I'm curious what the strategy looks like going forward. Are you looking to potentially acquire more businesses? Or are you happy with the portfolio as it stands?
Well, we're very happy with the portfolio that we have. I mean, we've done, as you say, a lot of expansion with almost $6 billion invested in North America and about half of that in Canada the last couple of years. We see Canada as a very strong market. We really were able to balance our portfolio in Canada with these last acquisitions, going towards more exterior products, matching our portfolio in the U.S. with roofing and siding, and then with Bailey allowing us to do systems for both commercial and residential. So it kind of finished out and finalized our portfolio for Canada. We will still look to grow in North America. We think it's a growing market. We think the dynamics is positive here, so we're always looking to continue to expand, but that's as opportunities arise.
What are you seeing in terms of, as I said at the top, supply chain and inflation, especially the latter, as the Fed moves to decide, well, on Wednesday and then again in September. Is inflation still sticky for you?
Supply chain has stayed relatively steady, so products are available, but again, there's high demand in certain of our categories. So a few of our categories are sold out and on allocation, so a little tight on supply chain, but able to meet the marketplace. Inflation has tempered, I would say, so there's not as much price pressure on raw materials. There's still some labor price pressure, and therefore prices going out the door have also moderated, haven't gone down, but just stayed relatively steady.
In terms of, you've been the CEO of the North American division here since the Trump administration. And I wonder about your experience under these two different administrations, Trump and Biden. Is there a difference in, the operational everyday business under each of those administrations?
Not really. We're fortunate to be in the housing and renovation remodeling market. So people need homes. It's a fundamental need. We kind of service the sustainability side of that market, making sure we can make products that are sustainable, lower CO2 footprint, lower energy cost for the homeowner. And that pretty much is universal across, I hope, all political parties. So we have not seen a big change. We focus on the end customer. We focus on our employees and try to keep that consistent regardless of who's in power.
Mark, we thank you so very much for your time. Of course, that is Mark Rayfield, CEO of Saint-Gobain North America. Big look here at that housing market and what it takes to build. And now let's get a check on the broader markets with Bloomberg's Abigail Doolittle. Abby?
So we do have stocks higher on the day, Sonali, but let's put it into the context of what has been going on. So over the last 3 weeks, we do have the NASDAQ 100 down. You can see pretty steadily the selling pressure. And at this point, over the last 3 weeks, down about 6.4% or so. This is the worst, longest streak since April 19th. So investors paring back a little bit on big tech, probably having to do with too far, too fast, plus election uncertainty. Let's take a look at the day, though, and see what's happening here, because as I was mentioning, we do have, well, the rally's fading a little bit. We have this S&P 500 up just slightly at this point. Take a look at the VIX, up 17. I've been tracking the VIX mainly around the election. It's been excellent in terms of moves higher on particular uncertainty. And I would say one factor of uncertainty around the election is just how tight it is between Kamala Harris, VP Harris, and former President Donald Trump. The 2-year yield, however, not confirming any sort of risk off. So really not an overall mood. That said, take a look at Bitcoin, up 1.1%. And as I was mentioning earlier, and as all of you have been talking about, Donald Trump over the weekend did endorse, if you will, Bitcoin and crypto overall. We took a look at this chart a while ago and have been wrong for the last, let's call it $10,000 to $12,000 per Bitcoin. However, I'm pretty confident that over the long term, we will see Bitcoin return to its long-term uptrend. One reason is it's happened many times. In 2017, when Bitcoin was overbought, you can see that it went into a deep bear market. A similar dynamic in 2021, and then a consolidation to the long-term downtrend. Each of these areas and consolidation up top. Right now, a smaller area of consolidation. You can see that the RSI coming out of the overbought territory on a monthly basis, Katie. It's also lower than the last time. That means that right now, the newer highs on Bitcoin, it's bearish in a way. There's a bearish divergence because there's less bullish momentum over the long term. This is a long way of saying that at some point we will likely see Bitcoin go back down toward 40. Might it pop up a little bit more from here? Absolutely. But again, this consolidation is likely ahead, I would say, in the next few weeks, months, or certainly this year.
All right, definitely going to keep an eye on that one. Our thanks, of course, to Bloomberg's Abigail Doolittle. Now, coming up, less than 100 days to go until we get to the U.S. presidential election. We'll take a look at how geopolitics and U.S. foreign policy are playing out in the White House race. Henrietta Treyz of Veda Partners is next. This is Bloomberg.
We're watching the price of oil as traders assess two developing stories out of South America and the Middle East. A rocket attack that killed several children in Israel-occupied Golan Heights is raising fears of an all-out war in the region between Israel and Hezbollah. And in Venezuela, President Nicolas Maduro was declared the winner in Sunday's election. The opposition is rejecting that claim. And joining us now is Bloomberg's Rosalind Matheson, and we're going to talk a little bit more about this uncertainty that we're seeing across the globe. But starting with what we're seeing in Israel, how are you monitoring the situation?
What we're seeing, obviously, is pressure now on the Israeli government to do some kind of retaliation. They're blaming Hezbollah in Lebanon for this attack on the Israel-occupied Golan Heights, as you say, killed a number of young people. We saw Benjamin Netanyahu out in the area there today saying the response would be harsh. The question is, what is harsh exactly? Because we do know that while he's under pressure to do something, he also, at this point, does not want a full-on ground war inside Lebanon against Hezbollah, which is in turn backed by Iran. So what we're hearing at the moment, there's no great movement of troops on the ground. There's no ramping up of the warnings in the area, but they are considering some kind of action, further targeted action against Hezbollah that would send that message of strength on the part of Israel, but avoid tipping things into that full-bore ground war. That's in part because, of course, Netanyahu at the moment is also focused on trying to get a ceasefire potentially in Gaza, where Israel is fighting Hamas at the moment. And if you have a ground war in Lebanon, you're not going to get a ceasefire in Gaza. So a lot of complicating threads at the moment for Netanyahu to deal with. But the bottom line is we're not expecting any major action against Hezbollah, at least in the next couple of days.
And it is awful to see these pictures of, children's bikes here and to hear this news about the deaths of those children. I want to ask about the situation in Venezuela. Roz, election obviously yesterday, Maduro claiming that he won, I think, 52% of the vote versus 44% for Gonzalez. But a U.S. firm, Edison Research, had an exit poll showing that Gonzalez actually won by more than 30 percentage points, and I don't think anyone would put it beyond Maduro, certainly not from our vantage point, to fix this election or to change the results. What will the U.S. response ultimately be?
Well, that is the big question, because in a way the US has heavily sanctioned and penalized Venezuela over the years, squeezing the economy very much into a state of hyperinflation, trying to cut off their access to global markets. And that's been to pressure Maduro to change course politically at home. You could argue that's not necessarily had the impact that's been desired, because many years later he's still there, and now he's claiming he's won the election again. So if the US moves back towards further sanctions against his regime, what will that necessarily achieve? And it has to happen, I guess, in the remaining months of the Biden presidency, in a very fluid environment in the US politically, because whoever's in the White House come early next year might take a different position, especially if it's Donald Trump. So the question of outside leverage on Venezuela has to be questioned. But also the question is, what can the opposition do at home domestically? Do they now try and bring people out onto the streets? Do they try and use mass protests to get action? We've seen that also happen before in Venezuela without significant impact on the Maduro regime. So the dilemma is, what can anyone do from the US, from other world powers, or internally to change this outcome?
All right, Bloomberg's Rosalind Matheson, really appreciate your insight there. And for more on geopolitics and what it means for the White House race, joining us now is Henrietta Treyz. She is Veda Partners Director of Economic Policy Research. And you have a note out recently saying that basically Kamala Harris still in the honeymoon phase. But then you think about really thorny issues such as geopolitics, such as what's going on with Israel and Palestine. I mean, how quickly could we see this honeymoon phase start to fade, basically, when we start to actually talk about the issues here?
Well, I think a honeymoon phase that lasts a full 10 days, which is effectively what we've seen for Kamala Harris thus far, is really long in this election cycle. I mean, it's been barely that amount of time since an assassination attempt on the former president. So the news cycle is moving very quickly. On the issue of foreign policy, it's almost a no-win solution for vice presidential and now soon-to-be Democratic presidential candidate Kamala Harris, in that both American voters do not spend a lot of time on foreign policy. Obviously, the Israel-Gaza conflict gets a lot of attention, but it's a microcosm of the Democratic electorate, and it is not something that necessarily moves the needle on a broad spectrum like gas prices, for example, or home prices. And then with Venezuela, There's obviously a very popular approach in the Democratic or the Biden administration's sense of sanctions, as you pointed out before. But increasing sanctions now or even lessening them is unlikely to move the needle materially, as you point out. So I think Secretary Blinken and others are working on it on the ground. It presents an opportunity for Kamala Harris to speak to the issue and present gravitas on foreign policy. But a resolution to either of those conflicts is not likely in the next couple of months. We only have 100 days left before the U.S. election.
With less than 100 days left, the other thing expected this week, Henrietta, of course, is her vice presidential running mate here in this election. How much does it matter to her, and what does it also mean for the broader Congress?
You know, I think that if we're going to keep it on the foreign policy platform, the number one area where she could make a dent is on immigration. So I don't have inside knowledge on who she's planning to pick, but in my opinion and basically my read of Capitol Hill, there's a real emphasis on choosing Senator Mark Kelly, a Democrat from Arizona, a border state, one who's worked tirelessly with Republicans for many months, sometimes in contrast to what the Democratic Party has tried to procure on immigration. And I think that's one of the clearest target areas for Republicans and Donald Trump to level against Kamala Harris. And so it would make a lot of sense from an optics perspective, politically, from a policy position, to go with Mark Kelly as the vice presidential nominee. The sheer gains that Kamala Harris has been able to make with Latino voters are in the 24-point range in just the last week of her nomination, as it were. So there are real paths to an electoral college change that now include Nevada and Arizona, Georgia, and potentially even North Carolina, where previously under Biden, we were really just talking about the Rust Belt. So an immigration focus makes a tremendous amount of sense for her, both politically and optically.
And you point out in your notes that when it comes to the polls, you usually can expect a bump after a VP pick is named. But I want to talk about how much the polls actually matter. I thought there were really interesting comments from New Hampshire Governor Chris Sununu over the weekend, talking to ABC, saying that this is a honeymoon period, to your point, but also that the first poll, I believe, that will actually matter is the Wednesday after Labor Day. So with that in mind, I mean, how much weight can we actually assign to the polling numbers that we're getting so far?
Well, you know, I push back just a little bit. American voters like to vote for a winner. So momentum is actually the narrative that you want to have. Yes, there are 24% of independents who will decide who they're going to vote for after Labor Day. And so that Wednesday is really critical in going into October. But you also want to have momentum on your side. And so when I speak with investors, we often are talking about who is peaked, where is momentum standing, where should we trade? And right now, it looks very much like Trump peaked too soon. He had a very powerful blowout to the last June and early July period, coming off of a very successful RNC and nominating J.D. Vance, who was well received on the right as vice president, and obviously a very sympathetic response to his attempted assassination attempt. And that boosted him in the polls. But what's surprising to me is how quickly that eroded. And now his approval is net down 8 points versus where it was just a week ago. And that's mostly because RFK Jr. voters, undecided voters, and dual hater voters who didn't like either Biden or Trump are now flocking to Kamala Harris. And as I mentioned at the outset, you're getting double-digit gains for Black voters towards Kamala Harris and Hispanic voters towards Kamala Harris. So all of the gains that Trump had seen in the last 8 months are being reversed, and that momentum is now propelling Kamala Harris. And I think it's shocking that we still have, 3, almost 4 weeks to go until the end of the DNC, where she'll name her vice presidential candidate the next couple of days.
Well, and that gives her a boost, right? That gives her a boost as well, Henrietta. She shows a new face in this election, and that could drive her momentum. Do the Republicans have any momentum drivers left? I mean, it seems like everything is to the downside as we discover more and more about what J.D. Vance believes now. It's 180 degrees the opposite of what he believed only a few years ago. We see waffling from President Trump on Bitcoin. He said it was based on thin air. Now all of a sudden he's madly in love with it. Do the voters care about these flip-flops?
Well, I think they do care. That's why his disapprovals are rising. And the more people get to know J.D. Vance, the more they decide that they don't like him. So that's a real problem. There's 3 things that I can predict from here. One is the DNC. That's usually worth 3 or 4 points boost in the polls, temporary as they may be. Then you have the post-Labor Day period, as you point out from Governor Sununu, is a very important time for people to decide how they're going to vote. And then we have to hold out the expectation that there will be some sort of additional October surprise. So of those three things, at least one is guaranteed to go in the Democrats' direction, and that is the DNC. The other two are up for grabs.
Henrietta, great to spend some time with you. Thanks for joining us. Henrietta Treyz there, Veda Partners Director of Economic Policy Research. Coming up, the market-moving events you need to be watching. That's next in our Trading Diary. This is Bloomberg. Let's get to the Trading Diary, what you need to be watching this week. We get central bank decisions from the Fed, the BOJ, and the BOE. Then more big tech earnings roll in. Microsoft, Meta, Apple, and Amazon all reporting this week. Other notable earnings this week include Starbucks and big oil results from Exxon and Chevron.
And all the while, we're going to keep a check on the markets. You take a look right now, giving up gains. The S&P 500 back to pretty much flat on the day. Big tech is holding on, up about 0.4%. Also, the Russell 2000 flipping negative as well. Not on the board, but just keeping that in mind. Meanwhile, the bond market still holding on to gains, only down about 1 basis point on the 10-year yield. That was 4 basis points earlier, but no longer. Now, coming up tomorrow on Open Interest, SoFi CEO Anthony Noto will be joining us. But that does it for Bloomberg Open Interest for now. This is Bloomberg.